Welcome to lesson 16 of business accounting, and during this lesson we will look at the difference between a general ledger and a subsidiary ledger, and we will also post our transactions in the ledgers. Now, why do we have subsidiary ledgers, and what is a subsidiary ledger? Now, a business, and remember in this semester we work with manufacturers. Now, a manufacturer will usually have more than one job at a time. And you can only think that they would like to have information available of each and every specific job individually. So they don't want to know that we have paid this amount in wages for all the jobs. They would like to know what was the wages, what was the material for this specific job. So in your subsidiary ledger, you will then have different ledgers or different accounts for different jobs. Now, what is the general ledger? The general ledger contains information of all the jobs. So in the general ledger, all the jobs and all the expenses are combined in only one account. So in the general ledger, you will find one wages account or one material account, while in a subsidiary ledger, you will find different accounts for the different jobs then. And because in the subsidiary ledger you can have this information for specific jobs, the information is easily available. You don't need to go to a general ledger and now to extract expenses for specific jobs. You can only go to the subsidiary ledger. Now, when you buy or when a company make use of a subsidiary ledger system, when they buy raw material, remember raw material is those that you will buy in order to produce something. So if you are producing office desks, then the wood would be a raw material. So when this business then buys raw material, they will first post it to the subsidiary ledger, and only at the end you will post the subsidiary ledger to the general ledger. This is just a presentation of your subsidiary ledgers. You will have different accounts for different jobs, and then all of these accounts will then feed into your general ledger account. So in this presentation, we have direct materials for job A, B, and C, and then all this information will feed into the direct material control account that is in the general ledger. Now, if we look at the recording cycle for a manufacturer, you will remember that you will have direct materials and you will have direct labor, and these were your direct costs. And then you will also have indirect materials and indirect labor, and you will now remember that indirect material and indirect labor is classified as manufacturing overheads. So first of all, when you buy these items, you will then record it in the direct material or manufacturing overheads, or then in your direct labor account. And this will be part of your subsidiary ledger. Then you will post it or you will transfer it to production. So these items, this material are now in a store, and when you want to produce something, you will now issue a requisition to ask from the store the materials, and then you will write it up in the production account or in the work in progress account. Some textbooks refer to work in progress and other textbooks to production, but these are then essentially the same. Now, when these goods are finished, so you are done with the office desk, then you will take it out of the production or work in progress account, and you will take it to the finished goods account. So this is basically the cycle that we will follow. We will now look at all the transactions and how you will write it up in the general ledger. I trust that all of you still remember the general ledger and how to record transactions in your ledger accounts. The cycle will start where we purchase direct materials, and in this scenario we purchased it on credit for amount of 10,000 Namibian dollar. Now you will remember in the general ledger you will always have two accounts because this is the double entry principle, direct materials and then creditors. You will also know that another name for creditors is then accounts payable, or you can also call them a supplier. All right, but as long as you are consistent. If you start to write it up as creditors, then you stick with creditors account. If you start with suppliers, then you just stick to suppliers. So don't in one set of books have a creditors account and then suddenly a supplier account also. Be consistent with the terminology that you will use there. Alright, so now we must decide on the debits and credits, and you will remember our abbreviation that we used POLS, and then you will know that direct materials is like purchases that will go to the debit side, and your creditors, this is a liability, and liabilities increase on the credit side. So in my debit account, direct materials, I will write the date, I will write the contra account. My contra account refers to my other account. So I will write the name there plus the amount. Then if I go to my second account, which in this case is creditors, I will write the date again, and then I will write the name of the contra account, which is the other account. I will just make a blue arrow there. So my contra account in the creditors account were direct materials, and it's 10,000. Now, are we still in balance? Yes, we are in balance. We have a debit, we have a credit of 10,000, so we are in balance. We now purchase indirect materials and paid by EFT. Now remember, indirect materials is classified as manufacturing overheads, so you won't have an indirect materials account, you will have a manufacturing overheads account. It's an expense, so it will be on the debit side. Bank, you made a payment from the bank, an EFT also always indicate that it's a bank account. On the credit side, because it's a payment, 2,000. Again, you can see my contra account names over there, and then the same with that account. All right, so remember then you have two accounts, one on the debit side, one on the credit side. Are we in balance? Yes, we have a 2,000 debit, a 2,000 credit. In this transaction, we issue direct materials to production. Remember that we discussed we will have a direct materials account, and then we will issue it to the production department because the direct materials will still be in the store. So now we issue it to production for 4,000, and we also issue indirect materials for 1,000. You will remember in my direct material account I had 10,000. Now I will issue 4,000. So on the credit side, because we are now reducing this asset, on the credit side 4,000, my contra account will be work in progress. There's my contra account. I can just make a red arrow maybe over there just to show you. All right, then I have my manufacturing overheads. I had my indirect materials on the debit side. I'm now transferring it to the work in progress account. So on the credit side, 1,000. And then on the debit side of my work in progress, I will find then my direct materials and my overheads. So in my work in progress account at this stage, I have 5,000. Now remember, when goods are in my work in progress account and when they are finished, we will transfer it to the finished goods. So transfer goods from production or work in progress to finished goods, and the amount was 2,000. You will remember on the debit side we had that 5,000. Now we will transfer 2,000 from the work in progress to finished goods. So write it up on the credit side, and then on your debit side of finished goods, we will have then a 2,000. Remember again, my contra accounts, there's my contra accounts, and then let's make a blue arrow over there. There's my contra account. All right. So in this lesson, we explained the accounting cycle. We started to buy direct materials, indirect materials, add it to my accounts, and then I transferred it to the production department in my production accounts, and then from there to the finished goods accounts.